Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork, and happy Friday. It's Friday, November 2nd. Hope you guys got some great plans for the weekend, and hope you guys have a wonderful upcoming day here. Uh, we got the big day today, the jobs numbers from the Bureau of Labor Statistics, which we'll start with first. We got the non-farm payrolls for the month of October. So the previous two months had revisions. They kind of evened each other out because September it was dropped, revised lower by 16,000, but in August it was revised higher by 16,000. So they kind of evened each other out, so it's kind of more or less unchanged. But forecast was supposed to be in around the 200,000 range for this coming payroll, and it came in much higher at 250,000 new jobs created. So fantastic news on that. We're seeing behind this. I didn't publish these, but the participation rate increased a little bit by 0.2%. We also have the U6 number also dropped a little bit. So those are good signs here. The unemployment rate for the month of October was at in September 3.7, and as you can see, it remained the same across. We had you know more the higher participation rate. We had new jobs coming in, more people being added to it. So just overall, it came in at the same number at 3.7%. Extremely low rates here. These are like the lowest unemployment rates we've had in like 50 years. So fantastic numbers there. Another item here is the average hourly earnings for the month of October. So September had a 0.3% increase. Forecast is supposed to be a little bit more moderate at 0.1%, but it came in a little higher at 3.2%. So this jumped up from 2.8 year over year to 3.1% year over year. This is the fastest it's jumped in 9 years, this average hourly earnings. And that's creating a little bit of pressure, as you'll see, coming up on the markets, or at least more in the bond market, primarily because uh, this is wage-based inflation. So this is an increase in inflation. We're starting to see that because it's a very tight labor market. Employers are starting to pay their employees more to retain them since the labor market is so tight as a result of this. So we're starting to see a little bit more inflation there, and of course that's the arch enemy of bonds. So as a result, you'll see coming up here that it's not looking so good. Last but not least, it's not do with the jobs. We got factory orders for the month of September. So in August, we had a great report here. It rose 2.3%. Forecast was supposed to be 0.5%, and it came in a little higher at 0.7%. So overall, good numbers here for the market here. But the stock market is down. It started the morning actually up quite well. It was actually doing quite well based on especially the jobs market. Q3 earnings are coming in here. Apple released their numbers yesterday after hours. Uh, they came in with good numbers, but they disappointed the investors because they came out with a not so good outlook. They gave them news basically saying that they're not going to include unit sales, and that's something that disappointed investors. So I think they're not liking that too well. But also earlier on, one of the big news was Bloomberg came out with a report saying that that President Trump had asked his administration to go ahead and come out with a draft proposal with China, so that way we can when they negotiate or meet up at that G20 later this month, excuse me, that they might be real close to it. So this stalemate between the two countries might come to a head. But then so the stock market was liking that news, so it's got more optimism. That's part of the reason why it was in positive territory. But as soon as a report came out, a senior official told CNBC News later this morning, said that that negotiations between agreement between the two are far off. The stock market turned negative, and so right now it's in the negative territory. It was way up around 200, now it's down over 100 so far in the Dow, and again overall it's down as a result. So that optimism got pretty much got a wet blanket thrown on it, for about a possibility of China and U.S. coming to a head on their détente. Let's go ahead and jump ahead and see these bond markets we were talking about. As you can see, we're dropping further and further. When I first started this, we were down by 20. Now we're down to about 36. We're hitting this Fibonacci level here, so we'll have to see if this holds this Fibonacci, but it's not liking the news so far today about wage-based inflation. As we insinuated, the inflation is the arch enemy for mortgage-backed securities or bonds, primarily because These are set over a 30-year period, and in that period with inflation, when we have inflation, it erodes or takes away that value of it. It kind of takes, so that's why it doesn't like inflation news. So, anyways, we're obviously lenders are pricing for the worst, and they may continue to price for the worst as this has been continuously dropping further and further down. You may see lenders do a price again for the worst, depending on when they release their pricing today. All right, so just be on the caution. It's kind of a big sell-off so far today. And as you can see here, we're going into the stochastic meter here is kind of showing us going into that territory of an oversold position here. Now on the yields, on the other hand, we're still in the middle here, but we're approaching its Fibonacci. We're taking off on this 25-day moving average that we broke above on Wednesday. And now we got the next resistance at the 319 level here. And so far we're getting pretty strong. We're pretty much right about the 3.20 or 3.20 range right now. So it's getting a pretty strong push. Your yields are, and that's going to create more pressure on mortgage-backed securities and push it lower if this maintains its current pace here. So be careful. If we break above this, the next one up will be the 325 level here, as you saw we had here. And it could create, again, more pressure on mortgage-backed securities, thus interest rates continue to rise. So fingers crossed. If you guys want to get any more reports, if anything changes, you can find me at Twitter. I will be posting any changes on Twitter. You guys enjoy the rest of your day and have a great weekend, and we'll look forward to see you guys on Monday. Thanks so much for watching, and see you then. Bye-bye.